Welcome back to the deep dive. Sometimes financial laws feel like they're written in, well, a totally different language.
They really can. Dense stuff.
Yeah. So today, we're trying to crack the code on something pretty unique in finance, these community-focused banks. And they're governed by the Mutual Banks Act, Act 124 of 1993 specifically.
Right, and this act, it really creates the framework for these institutions that sort of bridge the gap, between your huge commercial banks and a model that's really rooted in the community.
Okay. And it's from 1993. That sounds a bit old for finance law.
Well, the original assent date was July 9, 1993. That's true.
Mm-hmm.
But it's definitely not just a historical document. It's been updated a lot. The version we're looking at reflects changes right up to June 1st, 2023. So it's very much alive and kicking.
Good to know. So it's current.
Yeah.
And what's its main job, this act?
The purpose stated right in the text is pretty clear. It's to provide for the regulation and supervision of the activities of juristic persons doing business as mutual banks.
Right, regulation and supervision. But juristic persons doing business as mutual banks, let's break that down. What is a mutual bank, fundamentally?
So the juristic person part just means it's a legal entity like a company. It has its own rights and duties separate from the people involved.
Okay.
But the mutual part is key. Members become members because they're shareholders. And crucially, those members have the right to participate in controlling the bank, usually at a general meeting.
So it's member-owned, member-controlled, not like a typical bank where shareholders might be thousands of miles away and just want dividends.
Exactly. The person who holds a share could literally be your neighbor.
Yeah.
They potentially have a direct say.
Got it. So our mission today is to sort of unpack this whole setup, how they're regulated, the governance rules, how they stay financially stable.
And crucially, how this model fits into the much bigger picture of modern financial regulation, because that link is vital.
Okay, let's start there then. The modern legal context. You mentioned that linkage is important. What's the big player interacting with the Mutual Banks Act?
That would definitely be the Financial Sector Regulation Act, usually just called the FSRA. Its impact is probably the biggest change to how the Mutual Banks Act operates today.
Right, the FSRA. I've heard that mentioned a lot across the financial sector. How does it change things for mutual banks specifically? Does it replace the old regulator?
In effect, yes. The original Mutual Banks Act talks about the registrar. That was the old supervisor.
Okay.
But now, wherever you see registrar, you have to read it as the authority. And that means the Prudential Authority, which was set up under the FSRA.
So the Prudential Authority is the new sheriff in town.
Pretty much. And the FSRA is like the overarching law of the land for finance. If there's ever a conflict or inconsistency between what the FSRA requires and what the Mutual Banks Act says,
Let me guess, the FSRA wins.
the FSRA prevails every time. It sets the baseline.
So the Prudential Authority has quite a bit of power to shape how these mutual banks operate, potentially going beyond what was imagined in 1993.
Absolutely. And they do that using newer tools as well. Things that used to be set out in detailed regulations under the old system are now often handled through things called prudential standards or conduct standards, which are issued under the FSRA.
Prudential standards sound like they're about financial safety.
Exactly. Financial soundness, capital, liquidity, that sort of thing. And conduct standards are more about how the bank interacts with customers, market behavior, fairness. It lets the authority be more flexible, more responsive to, what's happening in the market.
Instead of waiting for Parliament to amend the whole act every time something needs tweaking.
Precisely. It's much faster.
And does the authority just set these standards, or can they actively enforce them day to day? What tools do they have if a bank isn't playing ball?
Oh, they have teeth. Yeah. A major tool is the power to issue directives.
Directives. Sounds serious.
They are. These aren't suggestions. They're legally binding orders. The authority can direct a mutual bank, or even its auditor, to stop doing something, or to fix a specific problem, or to provide information urgently.
Wow, okay, so they can step in quite forcefully.
Very. And what gives directives real bite is that failing to comply with one is actually an offense under the Mutual Banks Act itself.
So it links back to the original Act's penalties.
Yes. It means the authority can force change quickly, often without needing complex court action, just to stop a risky practice. It's about acting fast to maintain stability.
That seems like a powerful way to manage risk proactively. Okay, so we have this strong authority overseeing things. Let's go back to the beginning. How does a mutual bank even get started under this act? Chapter 3, I think.
That's right. Chapter 3 deals with establishment, and rule number 1 is crystal clear. You must be registered. Section 9 says pretending to be a mutual bank without being registered is an offense. We're talking fines or potentially up to 5 years in prison.
So no playing make-believe, you need the official, okay.
Yeah, absolutely do.
And getting that, okay, that authorization, it's not just filling out a form, I assume.
Definitely not a rubber stamp. You need at least 7 founders to start the process. They submit proposed articles, basically the bank's internal rule book, and the authority does a pretty thorough check.
What are they checking for? What are the main criteria to get that green light?
They focus on 4 key areas. First, is establishing this bank going to be harmful or detrimental to the public interest?
Public interest sounds quite broad.
It is. It gives the authority a lot of discretion. Second, does the proposed bank actually have enough money, enough financial backing?
Makes sense.
Third, will the business be run in a prudent manner? That means sound management, good risk controls from day one.
Prudent manner, okay. And the fourth?
This one's critical for trust. Every single proposed director and executive officer has to be assessed as a fit and proper person.
Fit and proper. That sounds like it covers honesty, integrity, competence.
All of the above. It's about ensuring the people in charge are trustworthy and capable.
Okay, so once you clear those hurdles and get authorized, the focus shifts to actually running the bank. Governance. And you mentioned fiduciary duty earlier.
Yes, this is absolutely central. It's the legal and ethical standard for the board of directors. The Act lays down a very high bar here.
How high?
Directors must act honestly and in good faith. That's standard. But then it adds they must act exclusively in the best interests and for the benefit of the mutual bank itself, its members, and its depositors.
All three. Members and depositors? That sounds like it could create conflicts sometimes. Prioritizing member returns versus depositor safety, for instance?
That's precisely why the Act words it that way. It forces directors to balance those interests. They can't just chase maximum profit for shareholders, the members. If it puts depositors' money at undue risk, it deliberately builds in a conservative check.
Interesting. A legal constraint on risk-taking, almost. And are there structural rules for the board, too, to reinforce this?
Oh, yes. There's a really important structural safeguard in Section 37, subsection 12. It puts limits on employee directors.
Employee directors, so people who work for the bank full-time, like the CEO.
Exactly. Management, who are also on the board. The rule says they cannot make up more than 49% of the board members. It's actually rounded down, so they can never reach half.
Less than half, okay.
And furthermore, even if they make up, say, 40% of the board, their collective votes at a board meeting are also capped at 49% of the total votes cast.
Wow. So management literally cannot dominate the board, either by numbers or by voting power.
Correct. This is designed explicitly to present what's called management capture.
Management capture.
Yeah, the risk that the internal executives start running the bank for their own benefit rather than for the members who own it. This hard cap ensures that independent, non-employee directors who theoretically represent the members and depositors always hold the balance of power.
That seems like a fundamental difference compared to maybe some other corporate structures. It really emphasizes the mutual aspect.
It absolutely does. It's structural protection for the members' interests.
And that protection extends outwards too, doesn't it? Through the auditors?
Yes. The external auditor has a crucial role that goes beyond just checking the books. They function as a kind of regulatory early warning system.
How so?
The Act requires the auditor, if they find any material irregularity or an undesirable practice.
Okay.
They first have to report it to the board, but if the board doesn't fix it or stop it within 1 month.
Only a month?
Yes, just 1 month. If it's not rectified, the auditor is legally obligated to report the issue directly to the authority.
So the auditor becomes an independent watchdog reporting straight to the regulator if the board doesn't act fast enough.
Exactly. It makes transparency non-negotiable.
Makes sense. Okay, before we get into the financial nuts and bolts, just a quick point on names. Are there rules about what these banks can call themselves?
Yes, simple but important rules in Section 20. The name can't be misleading, obviously. It can't be identical or confusingly similar to another bank's name.
Standard stuff.
And they have to display their registered name and the fact that they're registered under this Act on all their public documents, letterheads, websites, everything.
Clear labeling.
And interestingly, there's a restriction on using the term building society. Only registered mutual banks or full commercial banks can use that term now. It's a nod to the history, as mutual banks largely evolved from building societies.
Right. Preserving that link, but keeping it regulated. Okay, that sets the scene for governance. Let's pivot now to Chapter 5, the prudential requirements. This must be where the financial stability rules live.
This is the core of ensuring they're financially sound. It starts with Section 48, minimum capital requirements. A mutual bank has to hold a minimum amount of share capital and what are called unimpaired reserve funds.
Capital and reserves? The buffer against losses. How much do they need?
The required amount is the greater of two specific calculations.
The greater of two. Okay, what's the first one?
Calculation 1 is a fixed rand amount, are 10 million. There's a small exception for institutions that converted from old permanent mutual building societies for them. The floor is R1 million.
10 million rand minimum. Okay, and the second calculation, you said it's the greater of the two.
The second one is dynamic. It's an amount based on a percentage of the bank's risk-weighted assets and other risk exposures, as prescribed by the authority.
Risk-weighted assets. So the riskier the loans and investments the bank makes, the more capital it needs.
That's the concept exactly. Holding safe government bonds requires less capital backing than, say, funding speculative property developments. The capital buffer has to match the risk profile.
So it adapts. It's not just a static number that might become irrelevant.
Correct. It makes the requirement much more sensitive to the bank's actual activities.
And how is this capital structured? Is it all the same?
It's divided into two main types: primary and secondary capital.
Okay.
Primary capital is the highest quality, most loss-absorbing capital. Think common shares that can't be redeemed. Secondary capital often includes things like long-term subordinated loans. But these loans must be issued for at least 5 years.
5 years minimum for secondary capital. Why is that important?
Because secondary capital is subordinate. If the bank gets into trouble and has to be wound up, holders of secondary capital only get paid after all other creditors, especially depositors, have been paid in full.
So it acts as a buffer protecting depositors.
Precisely. And the 5-year minimum ensures it's a reasonably stable, long-term buffer, not just short-term debt.
Got it. So capital is one pillar of safety. What about liquidity? Being able to pay depositors back quickly.
Also crucial, the Act sets dual liquidity requirements. First, they need to maintain a minimum reserve balance with the Reserve Bank, following the standard rules there.
Okay.
Second, they must hold a minimum amount of liquid assets. This could be up to 20% of certain liabilities, depending on the category. And critically, these designated liquid assets cannot be pledged or used as security for anything else.
So they have to be kept free and clear, ready to be used if there's a run on deposits or high demand.
Exactly that. They can't lock up their emergency funds.
Makes sense. Anything else on the risk management front in this chapter?
Yes. Managing concentration risk. Basically, not putting too many eggs in one basket.
Right.
The Act restricts large exposures. That's when the total amount of money lent to or invested in a single person or a connected group of people exceeds a certain percentage of the bank's capital and reserves.
And if they want to make such a large loan or investment?
It needs special approval,
Yeah.
either from the full board of directors or from a dedicated board committee. And crucially, that committee must include at least one non-employee director.
There it is again, the independent oversight for big decisions.
It's a consistent theme. High-risk decisions need that external member-aligned perspective.
Okay, these requirements sound quite strict. What happens if a bank slips up? If they fail to meet the capital or liquidity minimums?
The consequences are pretty severe, designed to get their attention fast. First, the bank must report the failure immediately. The Act uses the word forthwith, no hiding it.
Forthwith.
And the authority can impose hefty financial penalties. For a capital shortfall, it can be up to 0.1% per day on the shortfall amount.
Per day. Ouch. That adds up quickly.
It certainly does. For a liquid assets shortfall, the penalty could be up to 3% of the shortfall amount. These aren't just slaps on the wrist.
No kidding. Charging daily interest on noncompliance really sends a message.
And there's another deterrent. It's actually a criminal offense for the bank to pay dividends to its members or shareholders while any capital or liquid asset shortfall exists.
So the directors can't ignore the problem and keep paying out members like everything is fine?
Absolutely not. Fix the foundation first.
Right. Okay, let's shift gears towards the endgame, chapters 7 and 8. What about evolution or even dissolution? Can a mutual bank change its form?
Yes, Chapter 7 covers that. The most common evolution is for a mutual bank to convert into a normal commercial bank. It then becomes a public company governed by the Main Banks Act of 1990.
How does that happen?
It needs the authority's approval, naturally. And it also requires a special resolution from the members. That typically means getting a high majority, like 3/4 of the voting members, to agree to the change.
So the members have to approve giving up the mutual structure. What happens to their shares then? A share in a mutual isn't quite like a share in, say, Standard Bank.
It's a really important point, and the Act has a specific protection here. When the conversion happens,
Yeah.
all the old mutual bank shares, except for certain types like permanent interest-bearing shares, are automatically treated as fixed deposits in the new commercial bank.
As fixed deposits. Interesting.
Yes, and they keep their original terms and conditions, including any tax benefits they might have had, for up to 10 years or until they're redeemed, whichever comes first.
That's quite a strong protection for the original members. Their community-based share doesn't suddenly become a volatile stock market share. It becomes a safe deposit.
Exactly. It cushions the transition and protects the value and nature of their original investment for a good while.
Yeah.
The Act also allows for mergers or amalgamation between mutual banks, or for one to transfer its assets and liabilities to another mutual bank or even a commercial bank.
But presumably with safeguards.
Always. The authority has to be satisfied that any such deal isn't detrimental to the public interest and doesn't cause undue hardship to the members involved.
Okay. In the final scenario, what if things go wrong and the mutual bank has to be wound up, liquidated? What's the liability for the average member, the shareholder?
Here, the Act provides significant protection for the members. Their liability is strictly limited. It's capped at the amount, if any, that is in arrear on their shares.
So only the unpaid portion of their share price. If they'd fully paid for their share, their liability is zero.
Essentially, yes. They won't suddenly face huge debts if the bank fails. However, the Act is also very clear that if a member was also a borrower,
If they had a loan from the bank.
yes, they still have to stick to their loan repayment schedule. That money is needed to pay back depositors and other creditors during the winding up process.
Right, you can't just walk away from your mortgage because the bank failed. Okay, so pulling this all together, this deep dive really shows the Mutual Banks Act creates this specific kind of regulatory environment.
It really does. It forces these community-focused institutions to meet very modern, quite demanding financial standards, largely driven by the FSRA now.
Right, demanding capital, liquidity, strong audits.
But all within a governance framework that keeps trying to embed that original mutual philosophy, protecting the member.
That cap on employee directors, the high fiduciary duty, they really stand out.
They do. They constantly signal that the priority isn't meant to be maximizing short-term profit above all else, but maintaining that long-term community trust and stability.
Which leads to a final thought, really, for you, the listener. We see this intense regulatory pressure, especially from the overarching FSRA, demanding sophisticated compliance. Does this complex environment actually help these smaller member-focused banks keep their unique local character and serve their communities effectively?
Or does the sheer weight and cost of all this modern regulation inevitably push them, maybe slowly, maybe faster, towards converting into standard banks? Regardless of the original intentions of the Mutual Banks Act itself.
It's a real tension in the market, something to think about.
Definitely. Well, thank you for joining us for this deep dive into the Mutual Banks Act, 1993.
We hope that was informative. Until next time.